Welcome back, or welcome, depending if it's your first time, to the week that
Welcome to 2025, although we did sneak in last week.
Can't keep saying that every week, Steve. Yeah. Anyway, I'm back with Steve. Are you well?
Oh, could kill it, mate. Could kill it. Market's expensive. There you go. Thanks, Chris.
See you next time. Look, I might set the scene for the next few weeks. So this will be the week that was for probably a few weeks.
Maybe, while you're in Tuscany or something.
Well, I'm over in Europe, yeah. But we're going to front load you. So
good for you. Don't worry about us back here, mate.
That's all right.
Don't worry.
We'll
just lose the audience while you float around the Amalfi Coast.
Well, I'm glad you give me that much respect.
But we do have something coming up. Drum roll.
Yes. So the next few weeks we've got a few specials coming up. So we've got a 2024 in review, which is quite enlightening. We've got some predictions for 2025. Call it quote-unquote predictions so we don't get sued by ASIC. And then we've got 4 specials on how to think about investing.
Yeah, it's a 4-part series.
It's a 4-part series, yeah. So it's something it's one of the masterclasses that you've taught for a while now, which tends to go down really well. So we've broken that up into 4, and that'll come over the next few weeks. So
while Jacob's in the Amalfi Coast.
While I'm floating around in a private jet, which will be good. And I won't miss any of you, by the way. Anyway, this week...
send snaps, mate. Send photos.
I'll try, yeah. Or not. I'm actually deleting you for 4 weeks, mate. I've had enough.
You got to do that these days. You got to rub it into your friends that you're in the Amalfi Coast, and here we are on the south of Portugal. It's puke.
We'll be in France, Venice, Norway.
Yeah, you and about 1 million Chinese.
Yeah.
Have fun, buddy.
Can't you just be happy for me?
You'd probably get out bird flu or something.
Yeah.
Righto, here we go. What do we got? Righto, hit that button, mate.
Well, look, we're covering Jan 13 to 17. And this is an interesting one, right? Because we get poo-pooed on CAPE more often than not. And it's quite funny. So the big issue that we're talking about is, are valuations, are tools like CAPE even relevant anymore?
Yeah.
Because there's a new era of CAPE and an old era of CAPE. And I think it's important just to cover what both are and how we're looking at the tool.
Yeah, look, this is always, again, what you get at, what we're trying to do is teach people about market cycles, right, broadly.
Yeah.
Right, just saying to people, the market goes up, the market goes down. Here's a tool. CAPE is not a timing tool, right? It's not a timing tool. It's a valuation tool.
Yes.
Right, and that's where a lot of people get it wrong by saying, if you were in CAPE, you'd have lost all these returns. Well, that's not right. That's not the way it works. And that's a little bit of I think they're those cheap arguments. So the important point is at the market top, like we're in, I'm not saying at the top, sorry, I shouldn't say that. But when the market's really expensive.
Feels like a top.
It bloody well does. It goes on for longer than you expect, right? And the issue we're trying to get across is that this is not different. This is just a standard market cycle. Everything's going gangbusters. Now, there might be some differences going forward, but the real issue is that it's like Warren Buffett, right? When the market takes off and Warren Buffett's buying Occidental Petroleum and everyone's in NVIDIA, everyone starts bagging Warren Buffett. The old dude's lost it this time. He's missed out on the greatest bull market. And they did the same thing in the .com, right?
Yep.
He went and gave a speech to Silicon Valley. It was some soiree, all these wanky bloody .commers were at, right? They're all making millions and billions of dollars, and they're all talking internet and .coms and a little bit the way they're talking about AI at the moment, right? It's going to take over the world, So Warren comes along, right? He gives an address which basically just says, you're all a load of wankers. You don't know what you're talking about. This is what's happened before with aeroplanes and railways, Everyone thought they'd change the world. And what he was saying was, okay, the internet will change the world. What's the price?
Yeah.
Right? I'm an investor. And so...
It's same as the tulip bubble and all the classics.
Exactly. And it's really just saying, again, the market's really expensive, Now, will AI change the world? Well, yeah, probably. But what's the price you're buying it at?
Yeah, exactly.
Right? And that's what I'm trying to show, what we're trying to show with the CAPE and the earnings yield. Because as I keep sort of pointing out more recently, everyone's watching the price action line, right? They're not watching the earnings yield line.
Well, I was going to say the same. So in CAPE, there's price and earnings, right? With the price being as it in the S&P 500 as an example, the CAPE being high doesn't mean sell out now immediately and don't invest until the price drops.
Yeah.
Because it could have a really slow 10 years where
Yes.
the CAPE comes down, but the price doesn't really move too much.
Yeah, 65 to 82.
Yeah.
I'm sort of warming to that because the American economy is going very well. Trump can probably derail it a little bit. Whether he derails it a lot's another story. So you would expect the economy in the US to continue to do well. Therefore, most people go, oh, I should jump into the stock market. And this is the argument we were just discussing, which was, yeah, but what's the price?
Yeah.
Right, I know you've defined the future, but what's the price you're paying for that divinity? And what I'm saying is it's really expensive, right? I can't predict it, but at this level, it usually falls 50%. I don't know how, I don't know when, but all I'm saying is if you put your money in the market now, you can probably expect, according to the earnings yield, you can expect about 2%.
Yeah, exactly.
Right? Well, during the week, I saw an ad for Macquarie, right? And that's not promoting Macquarie, but there was term deposits for 5.35%, I think. Well, 5.35 term deposit, no risk, government guaranteed up to 250 grand, or you can have, you can throw $500,000 in the S&P and get 2%, get a 1.
That's not too real though, right? That's just
yeah.
Oh, that's too real.
No. That's the earnings yield. Then you take away inflation and
exactly.
costs and stuff, and you're basically not making any money.
Yeah, are you going back?
So that's all I'm trying to point out is, let me take the next step. The alternative is people. Someone asked us during the week, well, okay, now what do I do? And it's like, okay, well, go and look where things are cheap. It might be cheap property in Perth, or it might be corporate bonds, right? Or, dare I say it, term deposits.
Yeah.
Right? 5.35 is, not too bad. I had a mate of mine during the week, I breakfast with, and he said to me last year, now, he's got a few bob, but last year he said, I made $90,000 in interest.
Yeah.
And this is part of my complaint that the problem we've got is a lot of wealthy people are earning a lot more money now because they're getting 5%.
Yeah.
Right? And they're going, this is great. It covers my cost of living. I'm actually making more money instead of spending more money.
Well, we say it all the time. The first thing we teach people is don't lose money.
Yep.
Like there are times to take significant risk, and there are times to look at it and go, maybe not right now. And we're kind of saying maybe not right now. You don't need to take a risk all the time.
Yeah, you're going to, you look at you're 30 years of age. Jesus Christ, you've got 40 years to invest.
Yeah. I want to get rich now, though, Steve.
Well, yeah. Well, you already are. You bought Bitcoin, didn't you?
Well, I'm in Venice.
Well, yeah. No, stop it. Move on. What's the next one?
Well, we got Monday.
Righto.
US market outperforming. It's obviously still connected to the rest of the world. So we keep saying this. If the US sneezes, everyone else catches a cold.
Yep.
Yeah. It's not new news.
Yeah. I'm just showing a bit of the argument is, here's the lesson. The argument is you should be diversified across asset classes, right?
Yeah.
Now, the problem with that is that we've gotten to the point where we think diversification is I'm in the US, I'm in Australia, and I'm in England. And it's like, that's not diversification because the correlation is like 0.9.
Yeah.
So just as you said, if the US sneezes, excuse me, the rest of us get a cold. So you've got to look at uncorrelated assets. So if you're heavily into the stock market, you might say, all right, well, I'm going to hedge it with gold or an investment property.
Well, you posted, I think, on the socials the other day, gold's outperformed stocks over the last 25 years.
Yeah, it has.
It's quite interesting.
A bit of a surprise. But that's the idea. When you talk about diversification, you've got to talk about things that are not connected. And that's why we talk about in the program, we talk about the difference between stocks and cash, because cash gives you the uncorrelated asset against your stocks.
Yeah.
Then you use the volatility in stocks
To rebalance.
using the cash.
Exactly.
Right? And that's the way, and that's why I say to people, it's different from property. You cannot buy a property and if the price falls 200,000 go, oh, that's all right. I'll just, I'll buy more of it. You can't do that. Right?
Yeah, well, it's so important to have, and people are so afraid these days for some reason to hold cash.
Well, yeah, because everybody's in Nvidia or Bitcoin or making money in residential property. So everybody thinks that if you're not getting 15%, you're not doing well.
Yeah,
And the S&P went up 25, right? So you look at it and go, man, I earned a lousy 15 and the US has gone up 25.
Oh, they're in a term deposit and they earn a lousy 4 and they're saying, Steve said I should have a term deposit.
Yeah. What is it that, I can't remember the old saying, but there's something about, we always compare ourselves, right? We're just naturally social animals. And you look at it and go, oh, man, Jacob made 100% in Bitcoin and I only made 22 in stocks. You look at it and go, dude, 22 is pretty good.
Yeah.
And will Jacob hold on to the 100? Well, you don't know, but you know what I mean?
I'll try my hardest.
Yeah, but you know what I mean? Like, you look at it when people are doing well, but seldom do you look at it and go, I'm up 5 and those dudes are down 42.
Well, this is the thing. Someone asked me this literally yesterday on my own personal socials, and I was about the Bitcoin stocks thing. I was like, mate, where Steve's different is he's done this for 30 years quite successfully. So, and I've done...
I'm like Warren Buffett, right?
Whereas I've been in the market for 10 years.
Yeah.
So me timesing that by 3 and getting that right over the next 20 years is actually going to be really difficult.
Yeah, well, the other thing is too, and that's why if we talk to people about investment principles, right? And as you say, if you use the right principles in Bitcoin, no problem, right? And I can say, look, I don't like it, but Jacob's making money out of it, not because of Jacob, but because he's using the principles we talk about.
Framework, yeah.
If you use it in property or in cars or in art, you'll do well because the principles are. So we're not timing, right? We're talking to people about things that work over time. We're not talking about things that work at the moment, right? Because the problem is things go pear-shaped, and if you don't have investment principles, you don't know when to get out.
Yeah.
Right? It's like, oh, well, should I buy it now? Should I buy more? That's why I'm saying you've got to have those principles to have your systematic way of investing to go, this is the way I do it. It hits that mark. Right. Okay. I sell or I rebalance or whatever.
Right? Exactly. Yeah. And it's interesting. A bloke messaged me saying, well, should I buy this specific whatever? And I was like, when are you going to get out? And he was like, what do you mean? I was like, well, you shouldn't buy then.
Yeah. If you ask a lot of people about their portfolios, you generally find they don't know when they're going to get in or when they're going to get out, right? And it's because they, build. I was talking to Jacob and his brother-in-law made $1 million in, like BHP. Oh, I should buy BHP. Jacob said it's really good. It's like, oh, right, okay. So
12 months ago.
Yeah, you're buying BHP. Everyone's going, when do we sell it? And that's what I mean. You don't know, right? Because you don't know why you really bought it in the first place.
Exactly. Consumer confidence kind of segues into that. It's still at not all-time highs, but people are still relatively confident that price is going to go up or it's going to do well. So it'd be interesting to see if it continues throughout the year.
Yeah, it's an interesting one, actually. I think it might be a bit of a Christmas blip. We had unemployment figures out on Thursday, which were a little bit misleading. We created unemployment, I think, went up a little dot. But and everyone was like, oh, that's really good. But you look at it, it was like, I think there was 90,000 part-time jobs, hello Christmas, and a loss of full-time jobs.
Wow, okay.
So, you look at that and go, and when you look at the underutilisation rate, right, people who are going, oh man, I'd love more work, the unemployment rate is about 10%. right? So that's why I'm saying, the idea that we're doing all right is, I think, very patchy. There was a fellow who wrote on X and said, I'm at the airport and it's, it's heaps of people at the airport. It's pumping out here. And I wrote, well, his question was, where's all this mortgage stress? Question mark, right? Because the airport's pumping. And I wrote and said, well, people who are under mortgage stress are not at the airport, bro. They're not going anywhere, right?
Yeah, that's true.
So again, you got to do that stuff where you go, the restaurants are full. Well, yeah, because people who don't eat don't go to a bloody restaurant to represent poor people, right?
Yeah.
You're seeing the people who can afford to go to a restaurant.
Mate, people go in debt to go on holiday these days.
Not all of us. But yeah, I know what you mean. So you're going into debt for Europe, are you?
Oh, yeah, something like that. Well, you should see the bill, mate. But I do a fair bit of travel for the day job, and the airports are pumping. And
Yeah. But it's a real theme now,
Yeah.
With Instagram, and everybody wants to tell people how many countries they've been to,
Yeah.
as if, look, I'm not, I'm okay with travel. I don't like it that much. I'd rather just take a drug and end up in Venice than go, you got to take a flight. And it's like, oh, no, God, I don't want to do that. Australia, Singapore, Dubai, London. It's like, oh, God,
Yeah.
And that sort of stops me a lot from travelling. But it's become, travelling is a status symbol now.
Yeah, that's
right?
true. Especially from Australia.
Well, yeah, because we're so bloody far away. But you know what I mean? Like, it's, if you read the global macro stuff, there's a lot of complaints about travel, right? There's a lot of, tourists are flocking to Venice and, Japan. I saw yesterday, 1 million Australians went to Japan last year, right? Including friends of mine.
Right.
So it's just, people are doing a lot of travel, but a lot of it too is a lot of old people, right? Because we've got the cash.
Yeah.
Right, I'm old, I'm retired. What do we do? We'll go to Europe, right?
travel.
We'll go to Venice. And
What did we work for all those years if we can't see anything?
a little bit, yeah. But again, it's this contagion, Jacob, of Jacob went to Europe. Oh, we should think about going to Europe. Yeah, we should. Jacob said it's great. Oh, okay, let's have a look. Yeah. We could borrow $5,000 and go to Europe. Oh, okay. But seriously,
it's a little bit like the property market.
I know, but that's what we are. We're social animals, and it's like, you go to a dinner party, there's 10 people and 9 have travelled, and you're sitting there, I went to the Gold Coast. And it's like, okay.
Yeah.
And people are, isn't the Amalfi Coast beautiful? Yeah, Portofino. And you're going, oh, right, okay.
But there's a zillion other people at the Amalfi Coast anyway, all catching COVID or something. Anyway, Buffett indicator on Wednesday. So it's what corporate equities divided by nominal quarterly GDP.
Yeah.
Basically, it's really high. We've been saying it for a while. The old man might be a bit worried.
Yeah, it's all expensive. That's for you, Chris.
We need to get the Doritos shirts
Out there and
as
listen.
well.
Yeah, we're going to have new shirts soon.
Yeah,
Expanding the budget here at
that's it.
Total Money Management.
$300 for a shirt, thank you.
Hugo Boss.
So Thursday we've got global equity valuation indicators. So this chart here is showing what, Steve?
Well, we talked about in the coaching call? Yeah, this week.
Yeah.
The principle here is mean reversion, okay? What I'm trying to show people is over the last long while, what you've seen is large caps have dominated over small caps. Growth stocks have really killed value stocks, right? Now, value and small caps have done okay, but compared to large caps and growth, you're going, dude, you are really missing out, right? Underperforming. Excuse me. And the other one, the final one there is the USA since 2009 has absolutely killed everybody, right? Europe, Australasia and the Far East, emerging markets. Now, with the principles of mean reversion, at some point that will change. Now, here we go back to CAPE. The CAPE in the US is 39. The average in emerging markets is about 16 or 17. And in Europe, I think it's about the same. So at some point, that's going to transition into there's better value in emerging markets. Like we talked about, Brazil's cheap, Mexico's cheap, Poland's cheap, South Korea's cheap, England, United Kingdom, for a developed country is quite cheap,
Yeah.
right? So that's why I say I know Cape's at 39, but if you've got a plan and you don't go, oh, Steve said Brazil's cheap, I'll put all my money in Brazil, right? You asset allocate and rebalance sensibly. That's where you should do better over the long term.
Correct, yeah.
Okay? And so what I'm saying there is we're getting to the point where with a Cape of 39, there will be a pivot out of the United States to a more attractive valuations, which will most likely be emerging markets. Now, they may suffer a decline if the US goes down, but they will or should present really good value.
Well, over the long term, the quote money makers, the big dogs, they're looking for yield. They're looking to put their money somewhere to grow, and there's going to be a point where the FANG stocks don't deliver that anymore.
Yes,
and they go, oh, well, let's slowly move out into what has some value.
Yeah. That's what. See, what we talked about too in the coaching call was what you've seen over the last 15 years is really big price growth. Right, so the dividend always remains about stable, right, 2-3%. What you've seen is the PE, right, the multiples go from 9 to 30, right?
That's hundreds in some cases.
Yeah, so you've got all this price appreciation. So it's again the same with property, where I say you bought it at $1 million. You're only yielding 3%, which is not much. Yeah, but the price growth has been fantastic. And it's like, that's good, but that will stop at some point. Trees don't grow to the sky, i.e. some people will get to a point where they'll be disappointed with 8 or 9% growth. They go, these things are cooling down. And it's 8 or 9 is really good. It's just that you're thinking 25 or 30, right? Well, NVIDIA's run out of puff, right? It's only growing at 10%. It's like, okay. But it's overvalued.
Yeah.
Right? And that's what I suspect will happen at some point. Things always get so ridiculous that someone goes, oh, come on, hang on, you guys, this is stupid. Right? And that's where the worm sort of turns a bit.
Yeah. Yeah, and we just don't know when that's going to be, which is why we keep going on about it. We'll be right one day.
I know where it is, and it's cost you $85 million to text me, and I'll tell you.
Takes the Steve line. And then on Friday we've got share buyback boosts. What are you trying to get across here?
Just the idea. If you've got, let me put this simply, you've got 100 shares in a company. And their shares cost $1, right? And it earns 10 cents, right?
Yep.
Okay. Now, if I say, Jacob, I'm buying back half the shares, the earnings per share goes from 5 cents to 10 cents.
Yep.
Right? Oh, Jesus, that's good. That's a double. Yeah, but I halved the share count. So what I'm saying, companies buy back their stock and then their earnings per share
simply goes up based on the fact that there's less shares.
For it to look good on
Yes,
paper.
yeah. And that's what's been happening for a while. Again, what happened was when interest rates were zero, what companies did was borrowed a lot of money to buy back stock.
Right, okay.
Right? That's what they do.
I think, who's the latest big company to buy back there?
There's a lot of them doing it.
Like Apple or something.
Yeah, Apple is buying back. Warren Buffett said he loves share buybacks, but he loves share buybacks of good companies who use their capital wisely. Coke, Apple, Bank of America. It doesn't translate into, well, if you get a crappy company and they buy back their own shares, usually they're doing it at a higher price, which is like, dude, you want to buy back your shares when they're cheap, not expensive. And that creates less value. And in other words, they're actually not using the capital right.
Right.
So from that point of view, but just there showing, as Lance Roberts said there, it's $1 trillion a year.
Buybacks.
Yeah.
Wow.
We're starting to get figures. There was something I saw the other day where I thought, my God, that's a very big number. And we're starting to get to numbers now. See, when I was a kid, being a millionaire was like, man, that was
really rich. Like my father had a friend who lived in Fiji, right? And they called him Ratu. I think that was a Fiji word for like king or something. I'm not sure. But he was a millionaire. And we were like, man, like Ratu's really rich. Now it's like, oh, yeah, got that in my property.
Yeah.
My house worth 1.7. It's like, oh, cool, right, okay. Like, the scale is, we now talk about centi-billionaires or centi-millionaires, like guys who have got more than 100 million. Yeah, Elon Musk has got like 250 billion or something.
Yeah, they're pushing for
or
the
even
trillion
more,
now.
400 or something.
Yeah.
So it's like physics. You get to a point where you go, I just can't.
It doesn't make sense.
I can't comprehend that. Like it's too big or.
We're all living in Elon's world, mate.
Yeah. Elonville.
So are we trying to tell the listeners anything here? Or should they be aware of anything?
Yeah, the idea is just to keep an eye on stock. Often when they're buying back stock, they generally do it at the wrong time.
Yeah, okay.
Right? But it's also because there's, they did it because there was cheap money about. Right. And when you get cheap money, this is why we've got property bubbles and stock bubbles and, all sorts of crazy stuff because there's cheap money. And so you can borrow and speculate and you don't need to make a lot of money. If interest rates are at 1%, well, if you make 2 or 3%, you're making money. Right. So at 7%, that's where you say, well, hang on, now I'm going to make 10 or 11. Right. That's a really big hurdle. But it's pretty easy to make 2% when people are speculating on asset values.
Yeah,
you can hold it for a short term and go, hey, I made 4%, good, fine, flick it.
Yeah, it forces you to take more risk, which makes most people lose more money.
Well, yes and no, but what it does is it just creates more and more bubbly prices.
Yeah.
Because everybody's bidding up the price.
Right, okay.
Right, and like you said at the start, they're not looking at the yield; they're just looking at the capital gain.
Yeah, most people don't even know what a yield is.
Or they discount the yield because they think they're going to make more on the capital gain.
Yeah, okay. All right. Well, before we get onto the lesson of the week, the last chart really is just on the forward PE ratios of the S&P. Let's say you got 1 year returns and 10-year returns.
Yeah.
It's basically showing that the yield looks crap, as we've been talking about.
I didn't put that in because I just sort of like,
We've been talking about it.
Yeah.
But lesson of the week. So what are we learning today? Asset class valuation scores.
Just the same of what we were talking about before with mean reversion is US assets have been really, really good. So if you have a look since 09, excuse me, since 09, when everything was cheap, the US has gone absolutely gangbusters. The rest of us have just gone wobbled around and now, we're not doing anything.
Well, this is arguably cheap.
Yeah, right? That's what I mean. So emerging market FX is, foreign currency. EM, emerging market. Developed markets, X the US. FM and
EM bonds.
EM bonds, right? So FM is frontier markets, I think. So what it's simply saying is the US is really expensive. Everywhere else is relatively cheap or is cheap relative to the US.
Yeah, the US have sucked the life out of everyone else. But these guys are all invested in US bonds.
Yeah.
So if the US falls, these are going to come down because it's their cash.
And stocks will be sold off.
Yeah. So asset allocate, which brings us on to dynamic allocation in the next lesson, which is basically, Templeton says what do we got here? Strategies and Philosophy of Legendary Investors. So that's a book that you've referenced.
It's John Templeton is a little bit like a bit like Warren Buffett, right? You buy undervalued stocks. Templeton was famous for, I think when Japan was really cheap, it had exploded or something, and Templeton instructed his staff to buy every single Japanese stock, I think, that was under $1 or something. Anyway, he did this thing, pulled off an absolutely magnificent coup and, of course, made heaps of dosh.
Yeah.
But what I'm alluding to here is we got a question on the socials about how should we be allocated, the Capes at 39. And if you look at this one, what I'm trying to point out here, and I think we may have spoken about this a few months ago, if you notice the percent market level below or above the normal zone. So the PE, see where it says 0,
Yep.
pretend that's a PE of 17,
Yep.
right? If you want to use CAPE, it's say 16, right?
Yep.
Now, what I'm trying to show there is when the market's 20% below normal, so let's say the CAPE is at 13, well, you draw an eye up and you say, okay, well, you maybe should have about 75 or 80% of your money in stocks.
Yep.
Now, when it's really expensive, let's say you do that in 2009, right? You go, oh man, the CAPE's really cheap. I'm going to put 80% of my money in the US market. Okay, and you do that. Now you come back 2025,
And it's here.
and it's the green dot. Okay, so it says, well, draw your eye across from there. You should have 10% of your money in stocks.
Yep.
But what a lot of people do is say, oh, but I've made, the US market's gone up 500%. So that would entail selling most of your portfolio.
Yeah.
A lot of people can't do that because they just feel like, oh, trigger capital gains tax. But my argument is, well, okay, but what happens if you lose 50%?
Pay the tax, sit in it.
And reinvest it,
Reinvest.
and go to emerging markets and, reinvest. Or, buy an investment property if there's a good yield about. Or, buy bonds or, but this is where we teach people to manage their money dynamically, right? It doesn't mean you've got to do actions every day, but just saying the efficient market theory is buy and hold, right? Well, no, because if you look at the market cycles chart and go, well, every time the CAPE goes crazy, it loses 50%, it's silly to go, oh, yeah, but you just can't pick it and you've got to suffer it. It's like, really?
Yeah.
That's a really dumb
Well,
argument.
people think you've got like one day to pick it. You don't. You've actually got to fight quite a long time.
Yeah. But it's also, again, allocating according to this yield, right? So if the things are really expensive, well, it's silly to stay there or to get in there. If it's really cheap, well, that makes a lot more sense, right? But this is why fund managers and stuff are always, in my mind, over-allocated, right? Because they're doing buy and hold. The diversification issue is a problem. Like when you get a big crash, everything goes to hell.
It's the best sales technique from fund managers. Oh, you just got to sit in the market. And
Yeah, you just got to hang it out. And that CAPE thing's bullshit. It's
I
like,
know.
oh, really?
No
Well,
one can time the market.
Yeah. But it again, like you're saying there, it's not about saying, oh, March the 9th, I picked it and, you could have invested anywhere in 2009, 2010
And done
and
brilliant.
still killed it.
Yeah. And
Right.
got and in the inverse, like you could got out any time in 2007, really.
Yeah.
And you'd have done
Yeah,
perfectly fine.
There's a lot of that goes on, right? Particularly as a criticism of CAPE, right? Like, oh, you'd have missed out on all the profits. And it's like, well, no. But secondly, you don't know what's coming. It's a 10-year indicator of valuation over the forward 10 years. So we might get to 2035. The S&P's gone down like it did from 2000 to 2010 when it lost 50%, right? We fast forward to 2035, you won't hear those people go, man, that CAPE thing was right in 2025, right? Yeah. And that's what I say. In bull markets, you get better returns than what CAPE says, and in bear markets, you get worse returns, right? And that's where the problem is. The problem is that transition part where it starts to roll over.
Yeah, that's important. Well, look, it might leave it there. If you've got any questions on dynamic allocation, as always, we get inundated with questions, but please send them because it helps us create these lessons. Other than that, we might see you next week.
See you when you get back from Europe.
Cheers, mate. Thanks, everyone.
As always, remember, we don't provide financial advice.